Welcome to Redact TV. I'm Don Friedman, President of the RIA Digital Assets Council. Today we have Lex Sokolin, Global Fintech Co-Head at Consensys. Lex, welcome to the show.
Thank you so much for having me. Really excited to be here.
We're excited to have you. So the first question that we have for you is, everyone says a big benefit of Bitcoin is that it's an uncorrelated asset. How has it performed during the pandemic?
Correlation is such a boogeyman a lot of the time. Being an uncorrelated asset has a lot of meaning in it, in the sense that the correlations that we're talking about are the fundamentals of what Bitcoin is are just different than the equity markets or the gold markets or just holding money for its own sake. So the things that are driving Bitcoin certainly are these same geopolitical questions that are driving other commodities, but also the technological vector of what it means to have a digital asset on blockchain, and all of the other adjacent infrastructure and financial services around it. Those are something that you get as exposure with Bitcoin, and you do not with any other commodities. Certainly not with pork bellies or timber or nuclear waste, whatever is in that ETF. But regardless, if you look at the numbers, correlations between Bitcoin and the stock markets have been coming closer together in the recent couple of months, and you can make the argument that it's not doing the job of the inflation hedge, or it's becoming more correlated than it's supposed to. But if you zoom out literally just a year, or if you zoom out for 5 years, you'll see that correlations go from being close to +1 to then going negative to then going positive again, and constantly swinging around. And so it's not that the correlation is close today, it's that over time that relationship changes, and it does create performance that is quite different and that is additive to a portfolio. And so I think from a diversification point of view, it still holds up as an argument.
Great. Next question we have is, all the talk has been about Bitcoin, but that's hugely volatile. That's why stablecoins are emerging. We got a pretty detailed explanation of what stablecoins are when we recently spoke with Lisa Nestor from the Stellar Development Foundation. So briefly remind our viewers what they are, and more importantly, please share with us why they are something advisors should pay attention to.
So from my seat at Consensys, where I spend most of my time thinking about Ethereum, which is a programmable blockchain. It's a blockchain that you can write software on. The talk hasn't actually been all about Bitcoin. It's been about this next generation of financial infrastructure. And that really means next generation of custody, of broker-dealers, of exchanges, and then the software glue that sits in between all of those things. So as you think about your portfolio management software, your trading software, your rebalancing software, your underwriting software, your payment software, all those things are in part being rebuilt on blockchain infrastructure that can touch digital assets. And so stable coins are essentially a cash equivalent, or a sweep, or a money market fund that lives inside open source programmable blockchains, of which Ethereum is the largest one by the number of developers and the software on it. There is, as of a couple of months ago, there's about $10 billion worth of these cash equivalents. Some of them are collateralized by actual dollars. Some of them are algorithmically managed, but they're pegged to the USD. And so again, like sweep inside of a Schwab account or a Fidelity account, you can think of these as something that people use as almost like a savings or a safe asset. And if we look at the volumes of trading and settlement, Bitcoin used to be the primary asset into which people settled when they wanted to take risk off in the crypto markets. And today they don't necessarily take that exposure anymore. And the number one asset that they use is the dollar. And so as we think about a growing digital asset ecosystem, having an institutionally backed, for example, Coinbase stablecoin is a key Lego to being able to create a full financial services ecosystem.
Interesting, interesting. Well, we appreciate your insight and thanks for being a guest on Readact TV.
Anytime.